Hey everybody, Derick Van Ness here, investor, wealth strategist, and life adventurer. And I've got something really important we want to talk about today, and that is universal life insurance. It's a super hot topic. Tons of people have tons of questions about it. There's a lot of people out there selling it. And I want to talk to you about some of the things that I see that are really, really important for you to know. And by the end of this video, you're going to understand exactly how universal life insurance works, why it might be a good fit or a bad fit. I'm going to tell you right up front, there are a lot of things I don't love about it, but it does have its place in the marketplace, and we'll talk about that as well. So buckle up. You'll probably want to pull out a pen because there's going to be some really detailed information. In fact, I'm going to do a screen share, draw all this cool stuff out for you. By the end of this video, you're going to have it totally dialed in. By the way, if you like these in detail, in-depth type of trainings, smash the like button, subscribe, let us know what's working for you. And I'll be sure to do more of them like this because it's a little different than our typical video. So anyway, if you're ready to do a deep dive into universal life insurance, here we go. I'm going to do a quick screen share so that we can do that. So you should be seeing my whiteboard here, and I want to take you through a couple of key things, and there's some important concepts to understand as we go through this. So the first thing is, as I mentioned, we are going to be talking about universal life, UL. Now, there are several different kinds out there. The most prevalent are IULs right now, which stands for indexed universal life, and VULs, which stands for variable universal life. And then there's also a GUL, which is guaranteed universal life. For the way that we're going to be talking through this, we're not going to talk a lot about GULs. They have a place, but they don't build cash value. They really are designed to have a more permanent death benefit a little bit cheaper. So that we will discuss in a different video. But let's talk about the components of universal life. The first thing to know is that universal life is really divided up into two things. The first one is, of course, insurance, right? And we all know that, life insurance. And if you die, it will pay out. The second one is an investment component, okay? Now, it's important that we break down both of these components because each of them has its own nuances. The first thing with the insurance, and this is what I think is not disclosed a lot, is people push universal life insurance like it's a permanent product, but realistically, it is based on what's called OYT, which stands for 1 year term, right? Now, as a quick disclaimer, there's a million policies out there. There might be one that's structured slightly different than this, but generally speaking, I've looked at hundreds and hundreds of these things, and almost all of them look like this, right? So 1 year term insurance, so that means it renews every year. And then the investment component, that's where the V or the U or the I comes in. So variable universal life is usually invested in some type of mutual fund. And these aren't as common anymore, but these were really common in the 90s and early 2000s. Indexed universal life is in an index fund, right? So that's where your money goes in for the investment component. Both of those are obviously based on the stock market and the returns that you'll get there. Index is a little bit different because your money's not actually in the market, but the idea is your returns are still based there. So here's the real breakdown of how this works. Let's say you're contributing, I don't know, I'm going to go with like $30,000 a year, okay? So let's say you're putting $30,000 a year into a life insurance policy that's a UL. Now, your payment every year stays the same, right? And that's about 2,500 bucks a month. I can put that here too if that's helpful. $2,500 a month. Let's just do it on a monthly breakdown. So of your 2,500, let's just say theoretically 500 of that is going to the cost of insurance, right? So this is your insurance piece. And then the other $2,000 is going into the investment, right? So this is your investment, and everything below this line is your insurance. cost, right? So that's great. Most of your money's going into an investment, can start growing for you. Now, the problem is next year, this is year one, next year you're a year older, right? So year two, because you're a year older and this renews every year, right? It's 1 year term, meaning that it renews every year. You're a little bit older, there's a little higher likelihood that you're going to die. So it might be slightly expensive. It could be that it's only $505 and this is $1995. But what happens is as you get older, the amount of the cost of the same insurance gets a little bit higher, slowly at first, and then over time, that cost of insurance rises and rises and rises faster and faster and faster, because as you get older, your chances of dying get higher every year, right? So their risk goes up. So as this thing renews every year, that cost of insurance goes up, right? And as the cost of insurance goes up from 500 to maybe over here, it's 1,000, the amount that's going into the investment is lower, right? So at this point in time, however old this is, maybe your payment is now $1,000 here and only $1,500 here, right? So what happens is at some point, usually, depending on how the policy is structured, there's a point where there's a break even, and meaning this entire $2,500 a month that you're paying is going straight to cost of insurance. There's no more going into the investment. Now, this varies depending on how the policy is set up, but a lot of them that I see, this is like your late 60s that this starts to happen, or early 70s. And we're going to look at an example, a real example in just a minute here. Late 60s, early 70s. So what happens is after that point, you pay in $2,500 a month, but your cost of insurance has fallen short. So maybe it's $3,000 a couple of years later. You're $500 short. So what the policy has to do in order to make up this shortfall, because your payment stayed the same, is they have to take money that's been growing in the investment over here and use it to help make that payment. So maybe $500 a month is coming out of all the money that you've grown in here over time. Now, if the stock market or your index fund or your investment portion does really well and makes lots of money, it can outrun this rising cost of insurance. But what happens is, everybody knows this, if you're using market-based assets, the market isn't positive every year. Now with an index fund, you won't lose money because the lowest usually on those is 0 or 1%. But if it's not making money, and we have to dip into it here to make up the difference on the payment here, this could be thousands of dollars a month that you're losing because you're earning 0 over here, but you're having to make up for the payment. And what that does is over time, that can deplete the amount of money that you have earning over here for you as your nest egg and eat it up in paying for the insurance. Now, if the market did well every single year, then this would work. But the reality is that the market has ups and downs. We all know that. So on those down years, especially once we get past these late 60s, early 70s years, we can start to go negative over here. And the following year, we have less money to earn with, and we have an even higher cost of insurance. And so eventually, a lot of these policies, if they're not monitored and altered, can collapse. Now, what happens if it collapses? It means you've run out of money here. Your payments are higher here. And so you have to start paying a whole lot more than $2,500 a month in order just to keep the insurance. If you don't do that, you can potentially lose every dollar you've put into the investment, plus the insurance will collapse and you won't have any insurance coverage. So to me, this is a real danger in this kind of policy because we don't know what's going to happen with the market. We also don't know how expensive insurance is going to get over time, right? And the reality is right now, people are living into their 80s on average, but over the next 10, 20, 30 years, depending on how old you are right now, people might be living longer. And if they live longer, then we have even further for this curve to go up over here. And that's a little scary for me, right? If you're going to be putting your life savings into something or a portion of your life savings into something, I think it's really important that it be protected. And I believe that most people are unaware that the cost of insurance rises like this. Now, there are some things that people can do to offset those. They can lower the death benefit. They can, try and tweak the policy as you go to keep your costs lower. But here's the thing: do you want to be meeting with somebody every single year out here in your 80s or your 90s to try and adjust your policy every single year to make sure that it's going to work out? For me, that's a big risk. A lot of people that I talk to, like when we look at their universal life insurance or their whole life insurance or their term insurance, they don't even know what they have. They haven't looked at it for years. If you start doing that over here, you can lose massive amounts of value, massive amounts of money. You could even lose everything. I've taken those phone calls where I had somebody call and they started a policy back in the 80s. And admittedly, policies are much better now than they were back in the 80s, but the one from the 80s, they've been putting $500 a month in there for the past 40 years. And now they have $0. Their insurance agent called them up instead and said, instead of paying $500 a month, you now have to pay $2,500 a month just to keep the policy because all the cash is gone. So how would you feel if you had put money into something for 30 or 40 years only to find out that all that money was gone, right? It's a really scary thing and it can happen, right? Once again, there's a proper way to use these policies. I just think for the average person, this isn't stuff that's being disclosed. The other thing that makes these look really good is when they show what's happening with your investment here, they show you an average rate of return, right? And we're going to look at this in just a minute, but I want to debunk that. A lot of times they're showing an average rate of return of 6 to 7%. And so what that average would mean, and the way they show it, is that you get 6 or 7% every single year. But averages aren't accurate in what actually happens with your money. And here's what I mean. If we take the average rate of return and we compare that to your actual rate of return, we come to discover that there's a really big difference in what happens with your money. So let's take a super simple example. Let's say you have $100,000 to invest, and you invest that, and in year number 1, your investment goes up 100%, which is awesome, right? So you leave the money in the investment, but the second year, things don't go so well. And so it goes down 50%. Well, nobody likes to lose 50%, so you pull your money out, but your investment advisor calls you up and he says, hey, you went up 100, you went down 50, so you're still ahead 50%. If we divide that by 2 years, on average, you're getting a 25% rate of return, right? And everybody that I know would take 25% as your average rate of return. But here's the problem, and here's why this is misleading. What actually happened is you started off with $100,000, then it doubled, so now you have $200,000, right? Then it went down 50%, so you went back to $100,000. You may have had to pay some fees, so you either broke even or you lost money. So how is losing money the same as a 25% rate of return? This is true, but this is what actually happened with your money. And this is what's tricky is when we look at the charts that I'm going to show you in a minute, they show you averaging 6 to 7%, but that's over here on the average side. It doesn't portray what's actually happening with your money. And the market doesn't do that every year. We all know the market has volatility, right? It does this whole thing, right? The ups and downs. And when we just average it out, it looks like this. But when we do the actual ups and downs of it, it's different, because when we have a down, this is 50% down from a bigger number. And this is 100% up from a smaller number, right? So right now, in August of 2020, the market, what happened back in March, and most people will remember this even if you're watching it way in the future, the market was doing really well, and then it crashed in March, and then the market has slowly crept back up. If you look at the numbers, what happened is the market went down about 35%, and now we are back up about 40%, but we haven't actually hit the same mark. We're only here. So you would think 40% up would be better than 35% down, but it's 35% of a bigger number and 40% up of a smaller number. So you can see how that can be very misleading, right? And that's what's happening with a lot of people and their misunderstanding around what's happening with their money. So I don't blame this on the universal life or that somebody's misleading you. It's just that the numbers and the way they're being portrayed, because nobody knows what's going to happen with the market, is not effective in showing what's going to happen with your money. So let's look at a real example, okay? This is an example of a policy that we just picked a middle-aged person with a preferred non-tobacco rating, so good rating, about $2,500 a month, like we were talking about, for $1 million of insurance. What happens here, so this is the guaranteed amount. So this is what would happen if you got like a 0% or 1% rate of return, right? And this isn't to pick on this particular policy. This is just an easy one to look at. So let's say you have $30,000 a year going in. The first year you pay in $30,000. I know it's 29.7, but let's call it 30 grand. You would have accumulated about $22,000 in the investment account. Now, one of the problems with these policies is in the first 10 years here, you can see that if you wanted to pull money out, you could only get about $2,300 out, even though there's almost 10 times that much in the policy, because the first 10 years there's surrender fees. So the second year you put in another 30 grand and it goes up to $45,000. And this has gone up significantly, right? So a lot more of your money is available, but still you have 45 in there and only 26 available. It takes a full 10 years to get to where the whole amount that you have in there is available. So short term, you don't have access to your cash. I don't love that part. And that's pretty common. I have seen one policy where that was not the case. So if you want early access to your cash, these aren't really great for that. We teach a banking system that people use for life insurance, and having access to your cash is really important if you're going to use that system. So this doesn't really work well for my clients. And then what happens is you can see as you pay in here, the amount of money that's accumulated in the account goes up and up and up. And then what happens is somewhere in here, we keep going down here, your policy right here at 593,701, let me highlight that real quick. This is the top of your policy. What happens is you keep paying money in, but now your policy is going down. The next year you actually lost $2,000, even though you put another $30,000 in. And from there, so we know at that point, the cost of insurance, if I go back over to this other page, we've not only passed this, we've gotten to the point where you're going $30,000 a year negative over here somewhere, because all the growth inside the policy is now not compensating for that, right? Right now on this, we're showing 0% growth. So what we know is, even though you put, the cost of insurance is about 30 grand at that point, because even though you put 30 grand in, you went negative. And you can see that only gets worse. It only went down 2,000 this year, but that year it went down about almost 6, almost 7, the next year 9. And as time goes on, as you get into your 80s over here, you can see that this gets worse and worse and worse. This particular policy, if you got a 0% rate of return, which would never happen, right? At age 88, all that money you've put in, $1,522,000 is all gone, and you have no insurance. Now, we know that you're never going to get zero forever. But what I want you to understand is, if we start looking at this, your policy at age 85, the cost of insurance, you put in $30,000, but it still went from 211 down to 125. So 211 down to 125 is about $85,000 lost, plus the $30,000 you put in. So the cost of insurance in that year is over $100,000 that you're losing, and you have to out earn in the stock market for that to be able to work. So the policy could implode. And even if you live longer, the longer you live, the more expensive it becomes, right? You can see the next year it goes from 125 down to 24. That means you lost 100,000, but you still put in 30. So you really lost $130,000 in 1 year in cost of insurance. Now, this isn't the chart that usually gets shown. They have to legally show you this, the guaranteed values. But what usually gets shown is a chart more like this. So they show your alternatives and they show your current illustrated values, right? So you can see here, they show what would happen if your policy got 3% every year on average. And you can see that the growth is much better. And with this particular policy, you can see that the break-even point, because your money's growing, is later in the policy, right? You get into your 80s here, and it seems like it just, yeah. It starts to go down right around here, around age 90, if you got that every single year. But if you live to 105, you'd lose everything. And you can see that this one gets pretty crazy once you hit like older age, 100 years here. And I don't know, people may be living into their hundreds in the near future, but you can see from age 101 to 102, now your cost of insurance, even though you put in $30,000, you earned 3%, it still went down about $300,000. So it's safe to say probably $350,000 for your cost of insurance. That means you're way up here on the curve, right? Really bad things are happening. And I would really prefer that you not take that risk. Now, over here on the right-hand side, this is another chart right here that shows what if you got, like I said, 6% every single year. And if you got 6% every single year, it works. Like it works like gangbusters, right? It's just that nobody gets 6% every single year. The reason that they can put this in most cases, and I don't know the exact for this particular company, most cases, the agent cannot list anything higher than their maximum, so they list the maximum allowable by law. And that's you getting the maximum allowable by law every single year, because people used to abuse these. In the 90s, people were showing 12% from here until forever, right? And so it's very difficult to see the cost of insurance when you're looking at that chart. And if you're looking at this going, well, I put in $30,000 a year, and even though I don't have access to much of the cash in the near future, long term, $30,000 a year by retirement is going to be, you know, by age 70 is going to be $3 million. That is possible, but if the market goes up and down like it always has, that's not likely. The funny thing is you can get this type of rate of return currently inside of cash value life insurance companies with whole life insurance, which is very similar. And you can see these kinds of rate of return right now. Now that may go up or down a little bit in the future. Everything's a little bit variable, but it does have a much higher guarantee point. So we prefer that for our clients. But if you just looked at this and you didn't know any better, you're like, wow, by the time I'm 89 years old, I've got $10 million in here. I can see why this is really, really appealing. And this is what agents show people, is that if you got 6% every single year from now until the end of time, you're going to end up with a huge number. The problem is it's never going to work like that. It's never happened that way. It won't happen that way, just like the 0% won't happen. So I think that these policies are being vastly misrepresented, because all people are focusing on is getting a 6% rate of return, 6.06 forever, and it's never going to happen. And at that rate, if we could get that, it would be a no-brainer. But why take all the risk? Why put your life savings at risk trying to outrun $350,000 of cost of insurance if you make it to age 100, right, per year? The next year, it's even going to be more. We just don't want you to get there. There are better ways to do this. And I think that there are better options. Like I mentioned before, there's term insurance, which does certain things really well. There's whole life insurance, which does certain things really well. They're all insurance products, but they're done really differently, in my personal opinion. And if you like this and you thought it was valuable, please hit the like button, subscribe, join us. But in my personal opinion, universal life insurance for most people is really dangerous. If you're a high net worth investor and you're looking at it as a cash machine and you understand what you're doing, you're working with some people, there are some ways to make it work for you short term. And those are something that we can explore, or if you have questions about that, drop them in the in the links below, and I'm happy to answer those questions. Or if you have a policy right now, you'd like to get it examined and see if it fits this mold, I'd be happy to look at those too. But the reality of it is, I think you deserve to know how life insurance works, how whole life insurance works, how term insurance works, how universal life insurance works. Because in my opinion, universal insurance has too many risks, not enough guarantees, and can be very, very dangerous if you don't understand what you're doing. So now that we're at the end of this video, if you want to know more about this, you can check out our other video on term versus whole life insurance and how those work. That'll explain the differences there and how that fits together. But universal life insurance, in my opinion, is not a great choice for the average person. It's short on cash in the short term. We have unpredictable returns with no guarantees other than best case scenario, 0%. We have rising cost of insurance that can be changed over time in many cases. Just too many variables. To me, this is like getting an adjustable rate mortgage that you're going to have for the rest of your life. And if things don't go your way, it can be really, really expensive and you can lose everything. I'd rather you don't take that risk. So my name's Derick Van Ness. If you have questions, let me know. Otherwise, check out the other video. Reach out to us, comment below. And if you like this, please smash the like button and follow us. Pass this on to your friends if you know anyone who could benefit from it. And I appreciate you stopping by. Thanks a lot.